Hey there, investors. This is Devin here, and today I wanted to go ahead and talk to you about a bit of a confusing subject for a lot of new investors when they hear me say that the average single-family home cash flow is only $300 a month. So basically, as I was beginning my investing journey, I didn't really know how much house cash flow is, just same as many of you, and I was a little shocked to hear this number, but I can say this comfortably after BRRRing about 6 properties now as of this point. I own 6, just got one under actual contract, and I'll be BRRRing this next deal. And I buy pretty much at least minimum 2 properties every single year. I can tell you this is very true that it's the average cash flow is about $300 a month. The problem is a lot of new investors are buying houses in such a way where they're seeing a much more large number. They're a little confused on why is it that my number is so small, but theirs is coming out so big. So I wanted to get into the details about that, why it is that anytime I hear someone say they're cash flowing, let's say $900 a month on a single family home, I know it's complete BS. So first off, I'm gonna get rid of the obvious one. There's a lot of investors out there that are thinking, okay, all I would do is take my how much money I'm making in the property and then what my mortgage is and then subtract the 2 and then boom, that's it. That's my cash flow. That's not how that works. And so if you don't allocate for maintenance and vacancies and all the different allocations for it, then you're gonna find that you look like you're making this much right now, but then as you're spending money, you're gonna average it all out and it doesn't really actually make that much money as much as you think it does. But generally, a lot of newer investors tend to be a little disorganized, especially with their expenses and their expense tracking and all of that, so they really don't understand how much they're spending on this property. So that's basically the first most basic step, but many of you aren't making that mistake in particular. You're actually making a different one, which is the whole reason that we BRRRR a house to begin with. Now, if for those of you who don't know, the BRRRR strategy is to buy, renovate, or refinance the property, or rent and then refinance the property and then repeat it. So the refinance part is the key part. What we are trying to do with the refinance is to get all of our money back. But some people aren't actually doing that. So like, for example, I met a new investor whom they bought 2 properties straight cash. Let's say the properties were $30,000. They have to spend like $20,000 in renovation. So they're all in for $50,000 each, basically $100,000. Now, ignoring the fact that most investors can't do this, just dump $100,000 in cash. Even if you could, it is not a good idea. Let's say for these properties, they can get $1,000 in rent a month. And let's say these tenants pay forever. They're great tenants and they never move out. It will still take them forever to get their money back. Remember, you don't actually start making cash flow realistically until you've made your cash on cash return. What that is essentially all the money that you put into the property and then trying to get it back out. If it takes you a long time, which in their case they were estimating like 10 years, then in all honesty, I probably would say unless the area is going to appreciate insanely well, which with these type of properties they don't, you really are probably better off just investing in stocks. I mean, you can just dump all that money in there and make the returns a lot faster than you could in real estate. The real benefit of real estate is to be able to leverage debt, that which you can't do in the stock market. This is a major benefit that they're completely missing out on. I see a lot of new investors kind of factoring this in. So once again, another investor, she bought a house hack. She bought a house hack and she spent $40,000 for a 10% down payment. And I'm sitting there like, why did you put 10% down on a primary residence loan for your house hack? And she's like, well, I just wanted to pay down the property and not have any debt. Or as much debt as possible. That's just her own mentality, her own way of thinking. It's apparently a cultural thing within her background, her culture, to just be debt averse. Well, the problem with doing that now is it takes forever to make back that money, that $50,000 or $40,000 in her case, that she paid and put into the property. So I'm like, well, now you just turned a good deal into like an okay or even garbage deal because you blew so much money in the process of actually buying it. So this is a factor that must be taken into account. I mean, even just the same person bought a property that they put, 3 people split $300,000 to buy a commercial property, and now they Airbnb, I guess, the top unit of it, and it's taking forever to get that money back. I mean, they have not even gotten close to it in the 2 years that they've owned this property. It's like I said, you would have been better off dumping all of that money into the stock market. So realistically, whenever I hear people saying they're cash flowing way more than $300 a month, unless there's a creative strategy like rooming houses or Airbnb or something of that nature, I'm really inclined not to believe it. I'm really inclined to wonder what was their cash they put in the deal. Oftentimes when asking this question, you get really weird answers like, oh, well, my dad paid for all of it, or, oh, well, somehow they got it for free in some fashion, or yeah, they just sunk all of the money into the property. And this will slow you down dramatically. You can't continue to invest at a rapid pace doing it this way. Now, some of you follow the Dave Ramsey method, and for most of you, I would say that's a good thing. That may sound surprising on this channel since I do leverage debt. As you guys may know, Dave Ramsey, for any of you who do not know him, he's a very popular real estate mogul. He does not like debt. He is catering to, let's say, a majority of the population who really shouldn't be in the real estate investing business, but really should just be securing a future for them and their families. But for those investors like me and many of you who want to buy properties quickly in order to amass a lot of wealth, you are going to do this far better and faster by actually leveraging debt. If you think about it, you can take that same 100 grand, buy that one house, and I can buy 4 different houses, now have my risk leveraged across 4 different houses, get principal pay down on 4 different houses, get appreciation on 4 different houses. I'm going to do far better than you by leveraging that on 4 properties than you will on 1. You might feel very comfortable not having any debt, but as long as you invest in properties that are highly recession resistant, then you're fine. This could be your Class C properties. If you don't know the Class A through D structure, then not a problem. But essentially, we're talking about neighborhoods that are kind of middle, lower income neighborhoods, not necessarily destitute poor vacants like in Baltimore City, but just in kind of lower end neighborhoods. These are highly recession resistant. Other ones are Section 8 or voucher programs. Other ones are rooming houses. A $600 room is never going out of style. So realistically, there are recession-resistant ways to invest, but ultimately, this is really what you want. If I leverage 4 of these, I'm going to become a millionaire far faster than you will sinking all your money into the property. So this is an important metric. Whenever you hear people say, oh, I make $800 in cash flow, or, oh, I have a 90% cash on cash return. These numbers can be very quickly considered BS if you have not analyzed all the different surrounding factors around it. In fact, a lot of times when people tell me how much they cash flow, I don't even listen to those numbers. And even on advanced investors, sometimes I don't even listen to their numbers because they're so, up there with how many properties they have. A lot of times their expense sheets and all that aren't even really up to date or as up to date as I would like to see. A lot of times I get skeptical even on their numbers. So just be really, really careful about that when you're hearing other people's numbers. What exactly are the details behind the house? You can't just listen to someone who's like, oh yeah, I have a 3-unit and I cash flow $3,000 a month. Sometimes we're even talking about before expenses and before the mortgage. So you have to be very, very careful about all of these different factors. I'm actually curious if any of you know someone who's done this, just thrown all their money into the property and pretty much got stuck with it at that point. But I'm interested to hear your thoughts, interested to hear your stories. Of course, this, for a $30,000 property, many of you may find that it's actually hard to leverage a property like that. For those of you who don't know, banks won't put bank financing on a $30,000 property. So sometimes you have to pay cash for that. But that's why you want to renovate it up to a certain standard, then refinance it later and get all your money back. That's the important part. So let me know if what you guys think about this topic, and I will talk to you all very soon.